Hey, it's DPerry, and I am a realtor with Property Consultants in Bucktown. And today, on Logan Square and Westtown Homes Live, I'm going to present to you your stress-free guide to shopping for home loans. Once upon a time, a guy said, "Don't worry, be happy." Well, hey, you need to be happy. Don't stress out. With this super simple breakdown of loan types, you won't get overwhelmed. You'll find the right mortgage. Now, when it comes to buying a house, most people know what they prefer: a bungalow or a condo, a hot neighborhood, or a sleepy street. Mortgages, too, come in many styles, and recognizing which type you should choose is just slightly more involved than, say, knowing that you prefer hardwood floors over wall-to-wall carpeting. Now, first things first, to pick the best loan for your situation, you need to know what your situation is exactly. Will you be staying in this home for years, decades? Are you feeling financially comfortable? Are you anxious about changing loan rates? Consider these questions and your answers before you start talking to lenders and before you choose a lender. Next, you'll want to have an understanding of the different loans that are out there. There are lots of options, and it can be a little complicated, but you know what? You got this, so here we go. Mortgages are fixed rate or adjustable, and one type is better for you. Let's start with the most common type of mortgage, that workhorse of home loans, the fixed rate mortgage. Now, a fixed rate mortgage includes the following. It lets you lock in an interest rate for 15 to 30 years. You can get a 20-year loan also. That means that your monthly payment will stay the same over the life of the loan. That said, your property taxes and insurance premiums will likely change over time. Now, a fixed rate mortgage is ideal when you want long-term stability and plan to stay put. Here's what else you need to know about fixed rate mortgages. A 30-year fixed rate mortgage offers a lower monthly payment for the loan amount, and for this reason it's more popular than the other option, the 15-year. Now, a 15-year rate mortgage typically offers a lower interest rate but a higher monthly payment because you're paying off the loan amount faster. Now, let's get into adjustable rate, the other type of mortgage you'll be looking at. An adjustable rate mortgage, otherwise known as an ARM, offers a lower interest rate than a fixed rate mortgage for an initial period of time, say 5 or 7 years. But the rate can fluctuate after the introductory period is over, depending on changes in interest rate, conditions, and the like. And that can make it difficult to budget. ARMs have caps that protect how high the rate can go. It's ideal when you plan to live in a home for a short time or you expect your income to go up to offset potentially higher future rates. Here's what else you need to know about adjustable rate mortgages. Different lenders may offer the same initial interest rate, but different rate caps. It's important to compare rate caps when shopping around for an ARM. Adjustable rate mortgages have a reputation for being complicated. As the Consumer Financial Protection Bureau advises, make sure to read the fine print. And a general rule of thumb when comparing adjustable rate loans is ask the prospective lender to calculate the highest payment for you that you'll ever have to make. You don't want any surprises. All right, so now let's talk about conventional loans versus government loans. So how do you know what's right for you? Well, your life will answer that question. Now, which fixed rate or adjustable rate mortgage you qualify for introduces a whole host of other categories, and they fall under two umbrellas: conventional loans and government loans. Now, conventional loans offer some of the most competitive interest rates, which means you'll likely pay less in interest over the period of the loan. Typically, you can get one more quickly than a government loan because there's less paperwork. Now, who qualifies? Typically, you need a credit score of 620 or above and a 5% down payment to qualify for a conventional loan. Here's what else you need to know about conventional loans. If you put down less than 20% for a conventional loan, you'll be required to pay private mortgage insurance, otherwise known as PMI. It's an extra monthly fee designed to mitigate the risk to the lender that a borrower could default on a loan. PMI ranges from about 0.3% to 1.15% of your home loan. The upshot is that the lender has to cancel PMI when you reach 22% equity in your home, and you can request to have it canceled once you hit 20% equity. So note, the lender is not going to remind you when you hit 20%. You have to keep your finger on the pulse of the market, and when it looks like you have 20%, then you should contact them to get them to cancel PMI. Save yourself a little money. Now, most conventional loans also have a maximum 43% debt to income ratio, otherwise known as the DTI, which compares how much money you owe on things like student loans, credit cards, car loans, other debt to your income. This is expressed as a percentage. Fannie Mae and Freddie Mac set limits on how much money you can borrow for a conventional loan. A home loan that conforms to these limits is called a conforming loan. Now, in most cities, the maximum amount for a conforming loan is $453,100. In high-cost areas such as New York, San Francisco, the limit is $679,650. So here in Chicagoland is probably somewhere in the middle. Limits are revisited annually and are subject to change based on each area's average home price. A home loan that exceeds these limits is called a jumbo loan. Jumbo loans typically require a higher down payment, up to 30% for some lenders, and a credit score of at least 720. Some borrowers can qualify while putting down 20%, but their credit score has to be higher. They also tend to have stricter debt-to-income requirements, generally allowing for a maximum DTI ratio of 38%. There are practical considerations to take into account before getting a jumbo loan too. Mainly, are you comfortable carrying that much debt? The answer depends on your current financial situation and long-term financial goals. Now let's talk about government loans. These include loans secured by the Federal Housing Administration, FHA, U.S. Department of Veterans Affairs, VA, and the U.S. Department of Agriculture, USDA, Rural Development Loans. And they're meant to stimulate the housing market and enable folks who may be unable to qualify for conventional loans to still become home owners. Now, who qualifies? Well, that depends on which government loan you're looking at. Now, if you've had trouble qualifying for a mortgage because of income limitations or credit, FHA loans may be used for you, and they're used by a broad swath of people, including those with lower credit scores and income. You can get an FHA loan with a down payment of 3.5% if you have a minimum credit score of 580. You can still qualify with a credit score below 580 and even with no credit score, but the down payment and other requirements will be much higher. FHA loans conform to loan limits set by county. These limits typically range from $294,515 to $679,650 in high-cost areas. You can view the FHA mortgage caps for your county at HUD.gov. Now, if you get an FHA loan, you must pay an upfront mortgage insurance premium called MIP and an annual premium of 0.85%. Currently, the MIP is 1.75% of the loan amount, so $1,750 for a $100,000 loan. This premium can be paid upfront at the beginning mortgage closing, or it can be rolled into the monthly mortgage payment. Also, heads up, the date an FHA loan was issued affects the MIP. So, let's assume that you're still hunting for a loan. We'll just look at what happens if you receive your FHA loan after June 3rd, 2013. To stop paying MIP, you have to refinance into a conventional loan and have a current loan to value of at least 80%. Now, if you're in the military, a veteran, or a veteran's spouse, VA loans offer active or retired military or a veteran's surviving spouse a mortgage with a 0% down payment. Hey, if you're in the Army, Navy, Air Force, Marines, you definitely need to take advantage of this. VA loans also can have more lenient credit requirements, typically around a minimum 620 credit score and lower DTI requirements. The VA only allows lenders to charge 1% maximum to cover the cost of originating and underwriting the loan. So you save money at closing. There is, however, an additional upfront one-time funding fee of 2.15%. VA loans also don't charge borrowers mortgage insurance, potentially helping you to save a significant chunk of cash on your monthly payment. Now, given the benefits, a VA loan is often the best mortgage option for people who qualify, namely current service members or veterans or spouses. Now, if your income is limited and you live in a small or rural town, USDA loans are mortgages for limited income home buyers in towns with populations of 10,000 or less and that are rural in character, meaning that some areas that now have bigger populations are grandfathered in. You can see whether your town is eligible on the USDA's website. USDA loans typically have lower interest rates than non-USDA loans. Down payments can be as low as 0%. USDA mortgages also have more lenient credit score requirements than conventional loans. Income limits to qualify depend on location and household size. USDA loans charge an upfront mortgage insurance fee of 1% of the loan amount and annual mortgage insurance premiums of 0.35%. USDA loan borrowers must buy a modest home, a property with a market value deemed reasonable for the area, though the USDA does not set specific price limitations. Only a select number of lenders offer USDA loans. And in the full article, you'll see a link to a list of USDA-approved lenders nationwide. If your job is to help people, in other words, you're a police officer, first responder, fireman, some sort of government worker, perhaps even a teacher, niche programs like the Neighbor Next Door from HUD will allow you, teachers, law enforcement officers, first responders, and government workers, as much as 50% on eligible homes in revitalization districts. Note, down payment assistance programs offer qualified buyers such things as grants and interest-free loans. Start with your state's housing finance agency to find options. Okay, so now that you know the basics, it's time to call for backup. Speaking of your lender, ultimately, you'll be working with your loan officer or broker to narrow down these choices and to find a loan that works for you and your finances. Just another reason why it's so important to choose a lender you're comfortable with. Now, your real estate agent should be able to offer some insight too. And because they don't earn a paycheck from your loan selection, their advice about mortgages should be impartial. Now, you know your stuff and you know whom to ask for help. Who's overwhelmed? Not you. So get out there. Don't worry. Be happy. Take a stress-free approach to getting a home loan. So once again, I hope you found value in that. My name's DPerry. If you need any help, or if you'd like to keep your finger on the pulse of real estate in your neighborhood or any area that you choose in Chicagoland, sign up for Market Snapshot. It's absolutely free. You can receive it as frequently or as infrequently as you like, and the price is right. And you can unsubscribe at any time with no obligation. All you got to do is click the link. Same link you see on the screen is in the show notes. Go ahead and click it now. What will you get? You'll get an email. There'll be a link. You click it. You see houses plotted on a map. They're color-coded according to their status: active, under contract, sold, canceled, etc. You can drill down into the houses. You can see room dimensions. You can see flooring. You can also get information on schools. How far is it from the home? Student-teacher ratio. In some cases, you'll see a school score. You can also get detailed info on shops, bars, restaurants, parks, etc. You can drill down. You can see reviews. You can see menus. You can get the phone number and the website of the business that you're interested in. So go ahead and sign up for Market Snapshot now. If you have any questions about real estate, call me, Doug Perry, at 312-572-9801, or you can email me at dperry@propertyconsultants.com. Both my phone and my email address are in the show notes. I'd love to talk to you. I'd like to meet you even better. Goodbye.